Excited today. It's Fantastic Friday, and we have a great show lined up for you. And because we do, I'm going to just take a really brief sound check in a second. But we have upped our game a little bit to 28 days of inventory. We listed 58 homes yesterday that are $475,000 and under. So let's see if you can hear me. Come on, Facebook. Okay, let's see. Can you hear me? Sound check. Yes, you can. Okay, great. Okay, won't delay the show anymore with that. And we have 738 homes available that are under $475,000 and under. So that's 29% of the available single-family homes. That's pretty good. That's pretty good, really. What else is remarkable? Oh my gosh, we listed 144 total homes yesterday, which is awesome. Now, I will tell you that 3% of the 58, or 5% of the 58 were open door, and that amounted to 3. So 3 out of the 58 were open door homes. I perused through them quickly. I didn't see where Zillow had listed any yesterday or OfferPad. So anyway, Alexis Rogers is up there doing her job listing homes. Anyway, we have 512 sales so far, which gives us 102 daily sales. We are ahead of last year so far. I know it's early hasn't even been a week in this month, but that's encouraging. A lot of times it takes more than 5-6 days to get above the previous month if we're going to get there. But it looks like we're headed in the right direction, which is good. Those $1 million homes plus are flying off the market, almost 5.5. It's 4.43. So that continues to be part of our sales and our dynamic market that we have here. Today, I want to show you a little bit about what NAR has to say LVR, excuse me, slow down, Ruth. These just came out. This wasn't out yesterday because I try to check during the beginning of the month so that I know when April stats come out the previous month. So they're saying that, of course, 475 was the median price. The new listings were 499. The median price of units available, including offers, was 515. Yeah, I think that's an interesting number. I wish Jimmy here would chime in, but I think that's an interesting number. The median price, including offers, was 515,000. So, and that's up 3% from last year, from last month. But look at this, 30.4% growth from April of 2021. That means that the price has gone up that much since a year ago in this statistic, meaning availability, including offers, median price last year was 30% less. And what's 30% of, that's a huge number. Jimmy usually does my math for me, but yeah, that was a huge number. Excluding offers, median price last month, excluding offers, median price of units available was 589. Wow. Oh my goodness. And that was up 18% from last April. So moving down, we have homes selling faster this year. Look at this. They're selling faster this year than last year. Oh, Jimmy Dake is here. Great, Jimmy. Great. Jimmy is there. So happy you're here. I wanted you to remark on, can you hear me?
Yeah.
I wanted to remark on this one statistic, and that is that the LVR just came out with their April statistics. So I check normally the first day of every new month to see when they come out. And the interesting thing, Jimmy, is the median price of units available, including offers, was 515,000 in April. And that is a 30% increase over last April. So I was saying, I wish Jimmy were here. He'd tell me what that 30% meant. So last year, if it's 515 this year, which is 30% higher, what was it last year, was my question.
Well, that's $45,000 difference. 55. Let's see, 3 times 15, it's 150,000.
Yes.
It's 150,000.
That's what I thought,
yes.
But I didn't want to say it.
Yes,
That's
150,000.
huge. That's unbelievable. Yeah. And I made pictures out of these, and I'm going to put them on the group for everybody if you want to use these as well as our stats. And the number of new listings, we're ahead. We're ahead a little bit. Look at that. I know I did this for you too, because I know you like charts. I have a harder time reading charts than you do. But availability excluding offers is 241. That's about what we have. That's about what we're saying. We're saying 2563 this year, this May. Last month, it was 2441 excluding offers. That was the average for April. But the number of new listings is up, which you know how happy that makes me. Yay. Yay. And we did list 144 homes yesterday, Jimmy, which is awesome.
Good.
Yes. Yeah. That was awesome. An awesome number. And I'm rushing a little bit because I want to get to the main event here today, but I'm going to post these stats for you all. This just shows the availability times on market. Our time on market is much less than it was last month even. I mean, they're just flying off the shelf, but we continue to list, so that's good. And then this is the main thing that I just showed everybody. So I'm going to post that for everybody, as well as our regular stat sheet. So today, Jimmy, we're going to talk about a few things. We're going to talk about, HousingWire is going to talk about interest rates, inventory levels, economic state, possible bubble, and oh yes, there's a war. And are these items on your mind? So I have broken this show up into two parts because it was too big to watch all at once. So there'll be a slight pause in the middle. And what I did, Jimmy, is I made a PDF. I transcribed the entire show, the entire 40 minutes, and I'm going to post after the show this PDF, and it shows who's saying what and what they're, it's a very well written script for everybody. So you have 33 pages, and there is so much content in here for people to use for videos, for their blogs, for whatever. And I'm going to pull some of this out for the Agent Formula blog because there's some really good stuff in here. And it'll be available if you're in the group, download it as a PDF. And otherwise, a lot of it will be on the blog if you have an Agent Formula website, which you can also download. And I won't post, the blog's not going to be 33 pages. I will take the key points and make bullet points out of it. So anyway, let's get started. What do you think?
I think if you have a 33-page PDF document, they can download that and take out whatever they want. So you're going to post a PDF of that, and then you're going to take some highlights and put it on the blog. You
got it. Yes. Thank you.
Yeah, great. Great.
All righty. So let's get started. Come on, get up there. All right. I'm going to mute us so we can hear them and we won't echo. So I'm going to mute me now.
Welcome back to the podcast. Super excited to talk about the things that are on your mind the most. Let me just give you some words. You ready? Interest rates, inventory levels, inflation. Should I wait? Did I miss the market? Is the entire economy about to explode? Are we in a bubble? And oh yes, there's a war. So do I have your attention? That's what today's show's about. And to help us get there, to help us unpack all this stuff, I've got Clayton Collins, CEO of HousingWire, and Sarah Wheeler, editor-in-chief. I'm stressed just having you on the show, Sarah, just for the record. So
she's judging all of us.
I'm not. Right.
She's editing our words.
I failed every English class and can't write at all, and I have 3 books. So thank God for editors. So Sarah, give us some context. So tell us your backstory. How did you get here? And briefly help us understand, what does it mean to be the editor-in-chief at HousingWire?
Oh, great. Yeah. I've been at HousingWire for 9 years. So I was there before Clayton Collins bought the company.
Yes.
Great time being there. My background is in both newspaper and in marketing, ad agencies. All of that kind of came together. And so I launched our sponsor content program back in the day. And now all of the content rolls up to me, whether that's news, sponsored, podcast, video, whatever it is. So it's fun.
So when you reach out to people, do people get nervous? Uh-oh. They're writing an article about me. Is it some of that
Potentially,
stuff?
yeah,
Yes?
yeah, potentially.
I'm sure you got a lot of writers for that, but like you're the big boss?
I do. I have a lot of writers for that. They do a great job. And so when I call, it's usually a more friendly.
Love it. Love it. And then Clayton, just so people have context, Sarah sort of dropped the bomb that you bought this company.
Yeah.
We got to know each other through a bunch of other transactions. Give them just some context. Where'd you come from? And then talk to us about what it's like to run HousingWire.
Yeah, I'm a banker turned housing media guy. So I started in banking, Citigroup in New York, then Royal Bank of Canada. At RBC, I fell in with a group that was doing a lot of M&A advisory of media transactions. So I was learning the media business on the transaction side, as many advisors do, kind of got the itch to be on the other side of the table and said, all right, it's time. Let's go out and find a business to acquire and operate. Grew up around the real estate and mortgage world, so the combination of this subject matter, this vertical and media just made perfect sense. So we acquired HousingWire in 2016. Spent a lot of time putting in place the right management team and tech stack and processes and all the things that it takes to get a business moving in the right direction. And since then, I've been charging forward on our mission that is all things housing. So we were trying to connect news and information across the entire housing vertical, from real estate sales to home construction and new home sales, home financing, refis, all the housing economy news that housing professionals across the ecosystem need, reverse mortgages, prop tech. So today we operate 4 brands: HousingWire, which covers real estate and mortgage financing world; Real Trends, which is covering the real estate agent and brokerage world; Reverse Mortgage Daily, and you guessed it, reverse mortgages; and FinLedger, covering prop tech. So that is our current fiefdom covering the housing world, but have big ambitions of where we're going.
It's so, first of all, congratulations, right? It's so interesting, the perspective that you guys receive, right? Because you talk to I try and talk to a lot of people. You guys talk to, I feel like, even more people than I could imagine. So your worldview of housing is very different. Like when I talk to Ivy Zellman as an example, or the guys at Keeping Current Matters, or, even some of the people at Inman, right? Everybody is getting all this, and then we put their filter on it and we put it out there. We want to talk today about these issues that are really pressing for people. So if we just start out of the gate and we say interest rates, the Fed told us they were going to raise the rates. Did no one listen?
Right.
They told us they were going to do it 3 times, and now we're like, interest rates, and what's going on? We're like, well, we were talking about this last year. So give us the state of the union on interest rates. What's happening? What can we expect to happen? And obviously this is, somewhat time stamped because we're sitting around April 19th. So what do you see? What do we need to know? Help us.
Yeah. So the thing that I think is most important when you're talking about interest rates is historical context. And if you look at the Freddie Mac data, that's been probably the most reliable source of data for tracking 30-year fixed rate mortgages for the last 3 decades, is we are in a multi-decade downtrend in mortgage interest rates.
Right.
And while it might 5%, we're kind of fluctuating around right now, might feel expensive, on a 30-year trajectory, we are at dirt cheap rates. And if you talk to anybody who is in this market for more than one cycle, hell, for more than 3 years, they know that the housing industry can operate, can thrive in a 5% market. And that's challenging, but there's we can take this conversation to buyer psychology and lender psychology and agent psychology and all the feelings that come when interest rates shoot up as fast as they did. And that's probably the most important thing to talk about here, is not that rates rose. Nobody should have been surprised at that. No. It's the velocity at which they rose, and how we went from, I think we were the lows were in November, December. We were talking about rates with a 2 handle on the front, and your smart homeowners and smart LOs got refied and got their clients refied in these 2.65s, 2.8s. We're not there anymore. We're at a 5% market. Still, right? It's not the worst cost of capital ever, but it's the speed of 3 months of shooting up. And there was a period a few weeks ago where we shot up 100 basis points or a whole percentage point in a week. And that's just, that's tough for a lot of people to stomach, but, historical context.
Please, Sarah.
I think the other thing is, the fact that the Fed, they did warn us, but they said 6 more times. I think that has freaked people out. And really, we don't know if that's going to happen. I mean, inflation is a bus they're running after as hard as they can, but is it actually going to be 6 times? We'll have to see.
Yes.
But the market is already pricing in those 6. And I think that's an important,
that's a key distinction. With home price appreciation index, they knew it was going to happen, and they're still saying 2027 all the way out, prices are going up. Yep.
So we can go to home price appreciation, but I think it's you have like people still scared that rates are going to keep moving at the velocity
Yeah.
they are, which feels like a very unlikely scenario considering that capital markets are already pricing in 6 rate hikes.
Right.
Now, if the stock market keeps shooting up and the Fed feels that like their purview on the market should extend to kind of restrict inflation through further interest rates increases, then hey, that could put some more upward pressure on rates. But right now it feels like we're pretty priced in, and I'm kind of feeling some stability.
What do you think?
I also think that, you have the opposite. You have some other forces. We're going to talk about war at some point. I mean, working in the other direction. So it's not clear to me inflation right now versus inflation in a month, 2 months. I mean, there's a lot of uncertainty right now.
I'll just put in my 2 cents because obviously you two are experts in this and live in it every single day. I look at the data and say, okay, are showings still happening? Yes, they are. Right? People are still out looking at houses. There's no doubt, like back in the summer of 2018, when it went from 3.9 to 4.9, like on a Tuesday, I think it was happening during one of my live events. Literally, It was 3.9, 4.9. I'm like, whoa. And everybody, the reaction to 4.9 might as well have been 490%, right? Because we were so used to that 3. Like we got semi-used to the 2. Even though we knew it was kind of a false economy, right? We just got used to it. What would you say to a home buyer, a friend of yours, who's like, oh, Sarah, I don't know. Did I miss it? Like I just feel like I'm buying it. It's high prices and high interest rate.
Yep. No, so I have had this conversation with my kids. So I have millennial kids and they're like, some of them bought, some of them haven't bought.
Yes.
They're like, am I missed it? And from my perspective, our lead analyst, Logan Motoshami, is on every week and he writes for us. And his feeling is that the demographics that are pushing the demand are good all the way through 2024.
Yes.
And in fact, right now you have all those people who are bidding on houses and losing. So I wonder if it even pushes out farther than that. So, and he's basing that on household formation during those years, millennials coming into their biggest home buying years, they want to buy a home. So even if it's 5.5, whatever it is. And so I've told them you should buy now, just like you should have bought last year, just like you should have just, you should buy now. You have not missed out because especially if you're buying a home to live in, that's the best way,
Right.
If you're buying it for an investment, we could talk about different things there. I'm not the expert, but if to live in, yes, you should buy.
Right. It's so hard when you're, again, like everyone knows that. I know that, you know that, like that's good insight to be able to say to people, anytime you can buy a house and hold it for long enough, you're going to do great. I just remind people, are you selling people a house today as an investment? Are you selling people because they want to get in and out of it really quick?
Right.
If that's the case, yeah, you probably missed the mark. But if you want to raise your family or start your life or, begin your new career, like this is definitely the time. Right.
But if you're buying as an investment, you have to look at the other side of the market. And part of the market is, hey, buy a house, live in it, raise a family, do whatever you're going to do. The other part is rent it out to someone else who's going to do that. True. What are rent prices doing right now? Right. Running even faster than home price appreciation.
I take all my thoughts back on investment. That's not what I meant. I was thinking short term, like the short term. I'm going to buy and try and flip this thing and get in and out of it.
Yeah.
Right.
Yeah.
Which you can certainly do that. But they may use hard money. They may use other levers to get it done. But I agree. So interest rates are going to be the way they are. Are we going to see the 6s?
I don't know. So I think if we do, you'll have to look at the war in Russia. That's what Logan has said. So that's not my area of expertise, but he really feels like to get up that high, then some of those other things are going to have to drop. Otherwise, the 10-year yield, people are flying to safety, then,
right.
all bets are off.
And I think just like we talk about home price appreciation and inventory and interest rates, like it is a housing market and like a market has two sides. And one of the Sarah's mentioned Logan, and Logan's been in a lonely camp the last few months as he's been calling himself team higher rates and talking about like
he could get lynched for that. I think. Someone's like, kill that guy.
Yes. By real estate agents. But if you are a homeowner who is sick of seeing 23%, 19%, whatever like market you live in, home price appreciation, higher interest rates are one tool that the Fed has to to control inflation and control home price appreciation. And so there is a counterbalance there. And there's other, like obviously we saw rates shoot up in the last few months and home price appreciation has kept running, but we have to see what the kind of the tail of that is. Like what is this recent increase in rates due to home price appreciation in Q2, in Q3? And it might be the control that this weird supply and demand imbalance like actually needs to bring the market back into balance. And so we talk about the housing market and we all want like success and great market dynamics
Frothy
right
and
now.
Yes.
But if you're in this for your career, like I am, I want a healthy, sustainable, accessible
Right.
housing market for decades to come.
Yes.
And when you look at demographics, if the demographics support continued transactions, people buying their first home, upgrading at some point, relocating, that's healthy. That if you can buy and upgrade and relocate when you want to. We're in a market right now where people don't always have that flexibility. The obvious next step might be too expensive. Relocating for that job in California might be off the table. Moving home to be with family in Florida, wow, real estate prices just doubled. So we have some dynamics right now that actually are unhealthy and can really get in the way of agents and loan officers and everybody else in the industry who are trying to build careers of steady transaction volume that they can grow their market share by being great at their job, not just grow their current year income because the market flooded them with an awesome opportunity like it did for loan originators in 2020.
It's so interesting. It's like what's going through my head is a client of mine, Paul, in Ottawa, Ontario, Canada, who has this beautiful teamerage, and he's frustrated by, hey, we take an $800,000 listing, 27, list it on Thursday, launch it on Friday, 27 offers over the weekend, final sales price 1.1 million. They've had like 43% year over year price appreciation in Ottawa, Ontario, Canada. And you sit back and say, that sure feels like a bubble is going to burst soon. So even though it was at the bottom of my list, let's talk about that. What's your sense of, look at parts of California, parts of Florida, parts of everywhere, every nook and cranny. Boise, Idaho. The president of my company moved from there. He moved from Boise to Dallas. He puts his house under contract. He closes 60 days later. By the time he closes, he's got more than half of the required 25% down payment for his loan already back in appreciation in 60 days.
That is crazy.
That's insane.
From my perspective, one of the things we talked about is how do you define a bubble?
Yes.
So a bubble is not just like things went down a little bit. A bubble is like it went down to where it started going up, which would be 2012.
Right.
If prices have to go back to 2012, you would have to see a 20 to 30% drop. And why would people do that? Why would people sell their house at a loss when they have great financials? That's the key. The homeowners right now, they have great balance sheets. Yep. They're doing great. There's no reason we have great jobs right now. So we don't have a job loss recession coming. We don't, is there a recession coming? Of course there's, these are cycles, but there's no reason for people who are in great financial shape to sell just to go and rent at a high price.
Yeah.
But not every recession is a housing recession.
There you go.
We all have this this recency bias in our head.
7, 8, 9, 10 has a lot of people licking their wounds. So they hear recession. That's all they experience. And this is not the case.
They hear that the value of the properties they currently own are going to go down. Yep. They hear that, I don't own anything now, so I'm going to wait until that bubble pops. I'm going to buy again, just like my friends and family did during the last cycle. Yep. That is not what any of the data is pointing toward right now. And what in real estate's a local game. So we can talk about like Boise or parts of California or Dallas. But when we look at it at a national level, the data is pointing, supported by jobs, supported by supply demand imbalance, supported by relatively still affordable interest rates. We have our home price appreciation has set a new floor. And so if we talk about a softening in home price appreciation, you're going to see the people who don't cover this every day and don't talk about it every day and see a data irregularity and call it softness. If home price appreciation flattens out, it could be a really good thing for the housing market. It does not mean that home values are popping or bursting or going down to great housing crisis kind of levels. And I think that's the really important distinction here is this housing market has found a new floor. Housing is more expensive than it was pre-COVID. And the demographics and the economic data is supporting this floor. So if home price appreciation fluctuates, comes down, probably not a bad thing, but rest assured the people who don't know this market well are going to see a slowing in home price appreciation and start crying.
But I also think, it's also, we need to talk about the loan products that people have. These are not ARMs. They're not
No.
underwater. They
Yes.
got 30-year fixed
Yes.
mortgages.
Yes, at
Vanilla,
2.65.
right? Vanilla. They're never
Yeah.
leaving.
You're going to brag about your interest rate until you die.
Yeah, exactly. And that does create that
Yes.
next problem of inventory, because
Right.
if you sell, you're a buyer. Why?
Yes.
No, who wants to sell in this thing? But again, who wants to sell? You can't have a crash.
Yeah.
It's not a bubble if you don't have a lot of people wanting to sell at a loss.
Doesn't it make you think if you're an agent today listening to this, you should be trying to get as much local data as you can? Because we talk nationally, right, on this kind of show where we're like, here's what's happening. We're 1.5 million properties we're going to build this year in the U.S. Well, what does that mean to me in wherever you are, right?
Yep.
You got to get the local data. You can get the local mortgage data to figure out how many homes in your marketplace have a mortgage, what percentage of your homes have 90%, loan to value, 15%. Like, once you start getting the local data, you're like, wait a minute, like, if the world hypothetically fell apart, we went into a recession, you're still looking at 39% of all homes across the country don't even have a mortgage.
Right.
Right? And then when you look at the percentage that these little money down, they've had so much appreciation since 2020. They went from 3% down. Now they're sitting at 20%. Right? So all of a sudden it makes you think, maybe I got to get out of the hype.
Exactly.
Okay, now, but you guys are in the media business. There's some hype in the media business. So I'm not busting your chops. I'm, like the old line, headlines do more to terrify than they do to clarify, right? So what's your prediction on the next 24 months? What's going to happen with inventory? What do you think is going to happen with, speaking of hype, this is fun, interest rates, inventory levels, and inflation? What's going to happen?
I'll go back to the hype and the headlines comment for a second.
A good media
Don't
guy right
let
there.
that go.
Yes.
So I mean, our mission at HW Media is moving the housing market forward. We're not writing consumer headlines.
Yes.
We're not out there trying to generate Facebook buzz. We don't need to build our business off of clicks. We need to build our business off of our most loyal subscribers,
Reputation.
readers,
Yep.
event attendees
Yep.
coming back to us year after year after year because we provide information, data, insights, resources, community that helps them be more successful real estate professionals. Now, if anything, there's times where we need to push down the hype. And that's why I'm talking. Why I'm forewarning that home price appreciation data is going to come down.
Yep.
And you are going to see from consumer focused big media outlets saying that a bubble is popping, but that is not what the data is actually saying.
Yes.
And so it's a funny position to be in. Yeah, we love big traffic days. Everybody does. You love to see when your podcast gets triple the downloads as normal, or 3 times as many page views, or we've had days where you have 100 times the page views as normal. That's great, but we're not writing headlines to attract the search audience, the prospective home buyers who are out there looking for a reason not to buy a home we're talking about. We're trying to inform industry professionals and give them the information they need.
Right.
So back to your question.
Keeping it real. So what
Next 24 months.
So just for fun, because before we started the show, we were talking about the data around showings.
Yep.
So I did get February, let's see. No, I got year over year, right? So let's see, showing index over the last 5 Februaries. So in February, we had 271. I don't know how they're giving me this. Do you see that? 271,000? I'm guessing that's on a monthly basis, right? Because that would seem pretty small for a year. Or it's 271 million showings, which sounds like too many.
That's an index. I think it's riding off 100.
Okay. So 271,000? It's got to be a
0.71 times the typical showing amount.
So, but what we're seeing is we're looking at 2019 showings were down from 2018. 2020, they spiked up a little bit, 160. 2021, they went from 160 to 240. And in 2022, they went to 270.
Yep.
So a lot of people are like, I almost think sometimes
Back to your question.
Keeping it real. So what
Next 24 months.
So just for fun, because before we started the show, we were talking about the data around showings.
Yep.
So I did get February, let's see. No, I got year over year, right? So let's see, showing index over the last 5 Februaries. So in February, we had 271. I don't know how they're giving me this. Do you see that? 271,000? I'm guessing that's on a monthly basis, right? Because that would seem pretty small for a year. Or it's 271 million showings, which sounds like too many.
That's an index. I think it's riding off 100.
Okay. So 271,000. It's got to be a
0.71 times the
Yeah,
typical
okay.
showing amount.
So, but what we're seeing is we're looking at 2019 showings were down from
Yep.
2018. 2020, they spiked up a little bit, 160. 2021, they went from 160 to 240. And in 2022, they went to 270.
Yep.
So a lot of people are like, I almost think sometimes agents talk themselves into the negative hype, right? They get concerned. Oh my goodness. And then they start talking about that stuff. So again, going back to the original question, what do we forecast for the next couple of years? What do you think is going to happen?
So I can speak to inventory, right?
Please,
So inventory is going to continue to be a problem. The builders are not incentivized to build, especially when you still have these supply chain
issues
problems.
and,
That does them no good. And really every house they build becomes the competition for their next house.
Right.
So I think learned back in 2018 is when they kind of got burned by that. So they're not looking to build a whole lot. No. Then we just talked about the fact that you have a whole bunch of people who have a super low interest rate and, have all this home price appreciation. Why would they sell?
Right.
We already are seeing housing tenure now above 10 years. It used to be like 7 years. Now I think it's closer to 15. And you can just see that that's probably going to continue. So if you don't have new homes and a lot of your existing homes, people are disincentivized to get out of because of interest rates, it's hard to see how inventory changes. And because of that, I think you still have home price appreciation because you have competition for the few houses that are there. You've got a ton of demand. You don't have enough inventory. You're going to have home price appreciation.
You look at the size of the millennial cohort compared to the boomers. The millennial cohort is bigger than the boomers, and the boomers, like I made a statement, and I'll get lambasted for this, but I say the boomers have to die for the millennials to buy. It sounds horrible, but they're
true.
Controlling all the inventory,
Yes.
including all the investment properties. So we know we're down 5 million properties. Do we have no hope for the future on builders?
I hate to say I don't think so.
Yeah, the housing market can't bet on new home construction to solve its problems. I think it is part of the solution, but it can't be the only thing we rely on. And we also can't rely on the boomers dying. The average boomer is not even 65 yet.
Exactly.
And
they're all living to be longer and longer and longer and longer.
Yeah,
so,
and they value aging in place, and they
Right.
want to be close to grandkids. They're not all flocking to Arizona and Florida. So there's other dynamics that are that keep boomers in their homes longer. The other thing that kind of compounds the differences between boomers and millennials is that the average boomer bought in their mid-20s, and now the millennials are buying at 32, and which is the reason we're in this wave right now. More people turned age 32 in 2000 than any other year in history. The only other year that was beat was 2021. The only other year that will beat is 2022, again in 23, and again in 2024.
I'm making the argument the same thing. I'm like, people ask me like, how's the market? I'm like, okay, well, yeah, we have less inventory. Interest rates are up. We have very real inflation. It's the greatest hedge to buy real estate. And then they go, but who's going to buy it? I'm like, this group. What do you do between 22 and 42? You graduate college, you get a career, you start a family, or you don't, but you buy something, and it's usually a house.
And and surprise, Gen Z is a little bit smaller than us millennials, but not much smaller. And the data that we're seeing right now is showing they value home ownership, or potentially might buy even earlier than the millennial generation did. Since I point to myself as a millennial, we're scarred by the experiences of our parents during 2008, 2009, 2010. So dynamics play a little bit different. But inventory, looking at 1.7 months right now, like just all-time lows. I mean, we look back, we haven't seen inventory has been on a steady decline since 2005.
Right.
And that it changes the market for originators and real estate agents. Transactions are still happening. They're just happening fast.
2005 or 2015?
It started declining in 2005. Yeah.
Okay.
Yeah. Well, and also
check this out.
Got it. Because I was thinking about the obvious spike of the horribleness of 7, 8, 9, 10. But
yeah, you see the spikes in there. Like there's some spikes in months on, or the monthly inventory at end of market, but like the overall trend is tightening.
And 1.7 months, I mean, that's national. So we know of all those markets where it's way less than a month, and it's even harder.
I look at this and say, I Googled a couple days ago because I was just curious, how many homes are right now? And it was like 386,000.
That's correct.
Yeah. Right?
Then nationwide.
The whole country, U.S., 386,000. Then you go back to a typical April spring market, 1.2 million, 1.5. We all hear these numbers, but when you hear that number, you think that's the entire country. Now, we all know there's a tremendous amount of off-market deals that are happening every single day. But the most important data point that I saw was kind of a green bar of old inventory carrying over into the next month, right? And we went all the way back, like, beginning of the pandemic, and literally looked at like February over February over February. And what we're seeing now is like this much green, this much blue, right? Like all the old, I would jokingly say to my clients, all the old crappy listings you thought would never sell finally sold at a record price, and you look like a star. The problem is now there's no more inventory.
Yep.
So it doesn't sound like we have any answer for that coming soon.
No. And I look
on a national level.
Like going back to this like 16-year trend too,
Yeah.
we're also like timing this with a digital evolution in real estate and a time in 2005 where it took several weeks to get the word of a listing out there, and you're still going through print. And now if you're an avid realtor.com or Zillow user, you're probably screening for listings in the last 24 hours or last 7 days.
Right.
So once something makes it past 14 days, like a lot of the new eyeballs aren't even seeing it.
Right.
So like, I think there's some like demographic and supply and demand things driving this long-term trend of lower inventory moving from staying on market from month to month. But we're also finally seeing some of the benefits of technology that are making the real estate market more liquid. It's easier to buy and sell. As hard as it feels as an agent, as hard as it feels as a loan originator, the timing to close a loan has actually gotten worse over the last decade. So we're not like in a better place,
Right.
But it's actually
Better,
easier
no pun intended, Better.
Yeah.
Sorry, Better.
Ooh.
Today's show is not brought to you by Better.
Visit HousingWire.com for more details on Tom's inside joke.
Okay, we kind of covered inflation. So let's switch to, a lot of consumers are saying, agents are saying, I'm like, what's the biggest objection, concern, worry you get? Did I miss it? Should I wait? Now, you talked about your own personal experience, but what does the data tell us?
I think the data says...
Long strategic pause.
I think the data says that at least through 2024 and probably a few years after, you're going to have huge demand that's driving prices up. So if you wait today, how long do you have to wait?
Right.
Do you want to wait until 2027 and maybe it'll come down by then? But then do we have Gen Z coming through?
Right.
So from my perspective, the demand is going to be there for the next 5 years. So you should do something now if you can. And did you miss it? Is like, well, I mean, we could all say that. I missed buying in California, in the 80s.
Yes.
Dang it, but
I knew I should have invested in Amazon.
right. So,
Yes,
but
yes.
to your point, even, and you can even still do investment deals now. I mean, it's not like you just if you're living in there.
There's an industry calculus and there's a personal calculus as well. And there's like every potential home buyer has to calculate the advantages, the intangible benefits of ownership versus renting, and then also the financial benefits of ownership versus renting. And if we're talking about markets where rent price growth is going up 40%, that 23% home price appreciation doesn't sound that bad.
Right.
And so there's a math equation that can be done here to figure out if in the current year it makes more sense to own or rent, and then what's that projected benefit going out. Now, I don't expect every homeowner and every agent to start running Excel models, but there's tools out there where you can do very easy cost benefit analysis between renting and owning. And if the economic data that we're reporting on, that we're talking to Logan about, we're talking to Mike Fratantoni about, the MBA, everybody at NAR, all the chief economists at CoreLogic and First American, the data is supporting a floor in home prices. And if home price appreciation slows, that still gives this prospective homeowner a roof over the head in the school district they want to be in, and the stability in their lives that most people are seeking when they buy a house. Now, if you're buying a house in March, or what month are we in now? April of 2022, because that you think in April of 2023 that house is going to be worth 20% more, and that's the only reason it makes sense is because you're getting 20% home price appreciation, that's a harder bet to make. Hey, it could happen, but I'm not rooting for that outcome. 20% home price appreciation, again, is going to put the overall housing market in a really perilous position.
I agree. It's so hard because we all own real estate. This is our livelihood, and you don't want to see anybody mentally cause themselves suffering.
Right.
But I've been saying to people over and over again, do you need time or do you need money right now? And what I'm finding is the very best agents, team leaders, broker owners, loan officers, what they need is time because they're so busy because they're not listening to the noise. They're keeping their blinders, kind of up and they're just doing the work, serving clients every single day. The loan officers are less busy, but the ones that were smart, that were really focused on agent relationships, they're busy right now. The other group's trying to figure it out. This group needs deals and money, right? So I'm just trying to tell people like, hey, if you're over here and you think it's hard, right? This is not hard. Try interest rates at 19.
Right.
Try interest rates at 11. Try just, summer of 18. That little, like we were starting to tick up and then it froze the market. Try selling real estate in the high end after 9/11, right? In New York City or Los Angeles or Miami, right? Like choose your hard, right? I think all the best people are actually birthed out of marketplaces like this. When there's uncertainty, the vast majority of people that aren't as committed, right, that were kind of riding the wave, start to pull back, and that's where everybody else can jump in and really make a difference.
Yeah.
What are your thoughts on that?
It's a difference between the professionals and the passerby. Like
Right.
our theme for HousingWire last year, 2021, was pivot to purchase. We were calling that in January.
Smart.
And anybody that listened, not just us, like everybody out there, every mortgage professional that has been through a single cycle,
Right.
2 or 3 cycles, they really know what's going on. But even through a single cycle, you
Right.
understand when you focus on purchase. And that time is all the time. You always
time.
you always focus on purchase. You always get close to your real estate partners. You always try to get close to homeowners and your past clients for referral business and return business. And it's the people who forgot that or came into the industry in a refi cycle that'll get flushed out. And hey, maybe that's fine. Maybe it's better for the industry. Hate to say that, but like it's a dynamic that's existed for decades.
I have a slide that I show a lot from October of last year that was a study of all MLSs across the country. And I'm about to get the new slide. So if you're listening, I want that new slide, which is the first quarter for the U.S. across the board. October said 73.5% of all the volume was done by 25% of the agents.
Wow.
That 51% of all the sales volume was done by 10%. So you've got 1.6 million agents, and we know there's a bunch of agents that are not affiliated with NAR, so call it 2 million, call it whatever you want. That means it's the rich and the rest. And I think I'm expecting going into this first quarter at the end of that number is going to be even tighter and greater. That the flight to quality for consumers is very real, and those that just put their head down and do the work seem to get more success than the ones that are sitting around the water cooler complaining.
I mean, we see that through America's Best Rankings that
100%,
Real Transactional
100%.
Media are partnered with you on
Yes.
there. And that I'm not going to like blurt out all the early
Don't give all the early
information.
stats. We'll do a whole live show on that
Yeah,
one.
we have the 2021 data in. We're doing our analysis now, preparing to announce America's Best in June. And it's pretty telling that these we collect data on about the top 1%, 1.5% of agents, but we're getting a majority of the transaction data that happens in the country. So like you're seeing this massive scale come from top producers.
100%.
And that's and we're not just talking about like the coastal top producers. We're talking about people who do volume in Texas. And it's interesting.
One of my clients in 2020, he and his wife and their team, Teamerage, right, did 864 transactions in 2020, did 3,025 the next year.
Wow.
Like we're talking like, but again, it's that consumer flight to quality. Who do you trust? Who does the right thing, puts out the right content. Like, I think the smart agent's going to listen to this, take 5 or 6 of your little micro clips and just put that into their Instagram, into their content so they can say, it wasn't me, Sarah Wheeler said it, right?
That's pretty much how I live my life. If I had to say Sarah said it.
Sarah said it.
No
You're like,
pressure.
I like that strategy.
To your point about flight to quality, in this kind of market, are you going to trust somebody who is a hobbyist? Are you going to trust someone who's, no, you're like, listen, if I have any chance of getting this offer done, I've got to have a professional. I've got to have someone who knows what they're doing. And so I do think you're going to have more shakeout.
Yeah. Yeah. And it's hard because like, I always say, like, I agree with you. And then I say to myself, that's somebody's spouse, it's somebody's mom, it's somebody's aunt, it's somebody's kid. But again, the industry churns at 2% every month. And the numbers show like 87% of people that get in the business 5 years later are out of the business. So I think that consumer flight to quality, and to your point around technology and better marketing, better educators, the people that are taking your content and putting that out there and doing like a video screen behind them of here's a HousingWire ad, or a HousingWire article, and literally saying, here's my interpretation of that. We're seeing more and more of that. That's who's winning right now on a broader scale. So let's end with war and economy. On a high note.
It's really hard to know what that's going to look like. I know over the last, 2 years, one of the things that Logan Motoshami has said is that we had a first shock with COVID-19,
Right.
and then we've adjusted.
Yes.
We've adjusted to it in the way that we consume goods and the way that we work and in every way. And so you wonder if, to your point, we're fighting wars all the time. This one is a very visible one, and it has some real impacts on energy, on supply chain. So it is more impactful than maybe some of the things going on in the world. But at the same time, we adjust. So to me, it's a short term. Even if the war goes on, we will learn how to do this within the war. That's my take.
The tragedy is we got used to it in every other war.
It is sad, right? It's terrible.
I hope for the person that if you're just listening, like the frown on my face, like it's just, it just, ugh. Right? Like, really?
Yeah.
But then again, like having friends in Ukraine and having friends in Russia, like you just hate to see that suffering at scale. And now it's not a war on CNN. It's a war on TikTok.
Absolutely.
It's a war on, like you see it everywhere you go. There's just this real content. So I think it creates just a layer of sort of black cloud for some people. Like we finally got the layer of COVID off, especially today, right? Like you can get on airplanes now with no more masks, right? Which is exciting. But now there's like this new layer, and I think it just creates more uncertainty for people.
So, I mean,
not trying to be a buzzkill here, Clayton.
We can equate that like uncertainty to sentiment. And that's where I think
Yeah.
probably the most important thing to talk about is like the global economic stage impact on the U.S. housing market. A big part of that is driven by sentiment. So we talked about home builders a little bit earlier.
Right.
I had Rick Palacios from John Burns on the Housing News podcast last week, and the March home builder sentiment survey that John Burns has been doing for 13 or 14 years is kind of like the bellwether for home builders. Massive drop off in sentiment in March from February, primarily driven by two factors. Were primarily predicted to be two factors. There's a third in there. So one, supply chain. The global stage is messing up supply chains, and obviously, like the bigger concern is the impact it's having on the citizens of Ukraine.
Right.
But there's the supply chain impacts are large and far-reaching, and those supply chain problems began long before this Ukrainian conflict to start with. So supply chain issues are huge. That flows through to higher materials costs. Labor. So the labor market is incredibly healthy. We're at like 3.7, 3.8%
Under
unemployment
4%
right now.
unemployment.
I call bullshit on that number.
Let's go for it.
Okay, I was listening to this podcast with a woman she was like one of the great advocates of the early days of women coding. And she was, so now her new thing is like during the pandemic, 11 million women walked out of the workplace to take care of their husbands, their kids, their lives, and decided, hey, I'm out. So I hear these large chunks of numbers and I haven't heard them come back. So when I hear that like 3.7, even like, I don't care, Obama, Trump, ding, ding, ring-a-ding, name the lunacy, right? They always talk about these numbers, but there's that giant group of people that have just checked out.
That opted out of the workforce.
Right. So I hear you, and I'm not calling BS on you. I'm just saying I hear those numbers and I'm like, I don't know.
It's hard to say. I mean, job openings, we have 11 million job openings.
I know.
11 million. So you have to go.
I feel like I have all those. Yes. Yes.
Us too. And so you go, if you have opted out for different reasons, have those reasons changed and now you're opting back in.
Right.
Sounds like something we should look at.
Or not opting back in.
Right.
And then the number is real. But ultimately, like wage growth is happening right now because of inflation and because of low unemployment. Now, if people who opted out of the job market during COVID decide to come back in, maybe that will put some pressure on the wage growth, and we'll see wages kind of return to a more normal level. But when you talk to people in the home building industry, the wage stories are insane.
Right.
And like essentially like doubling the cost of labor in some markets for certain trades. And that puts a lot of pressure on new home prices, and it puts a lot of pressure on builder sentiment. So I mentioned supply chain, I mentioned wages, and then interest rates. So builders got scared to death when they saw that 5% number.
Right.
Changed really quickly. So I was talking to Rick about this anecdote in Charlotte. There's a new home community with 51 houses and a wait list of 1,000 prospective home buyers. Like that's insane. That's 51 incredible. Houses, 1,000 people waiting. That wait list has shrunk as rates hit 5%. Not just because potential home buyers got skittish or their sentiment weakened, but because they actually got qualified out due to affordability. So their non-purchase focused loan officer qualified them for that house at $500K at 3% interest rates. Right. The home price has now gone up to $550 or $600. Interest rates are 5%. Yep. So their payment has just jumped a considerable amount and they can no longer afford it. So homeowners or home builders are scared of that dynamic. Yes. And when home builders get scared, they retreat and they bring less houses to market and they slow down and they control their pipes. Like Sarah mentioned earlier, every new house they bring to market is the last one's competition if it hasn't sold yet. It also helps set new floors. So if you're building homes in a 51 home community and you can benefit from the last house having more pressure on it, so it sells at 3% higher. Next one sells at 3% higher and 3% higher. You get to the end of that. That's why we release
plan A, plan B, plan C, plan D, right?
Yeah, it's an experience.
Bam, 51.
It's an experienced industry. They know what they're doing, but sentiment matters. So we have what's happening on the global stage impacting consumer sentiment. And Fannie Mae just did a study that came out in the last week, and I think they're seeing consumers believe that their housing is becoming less affordable and more difficult to find, so they're just opting out of their search. But we still have this supply-demand imbalance that is weighted toward the demand side. So even as some consumers, prospective home buyers, prospective trade-up buyers may opt out or may sit on the sidelines, the demand imbalance still sits there. So it's you see weakening in metrics, but the imbalance still persists that should drive continued health and appreciation.
Yeah, I was talking to Ryan Lundquist. He's an appraiser in Sacramento, which is a huge hot housing market.
Crazy market.
And he had metrics through March about our homes being sold above or below listing. Actually, in March they sold above listing more than they did in January and February, either at or above up to 25% more. But okay, that was March, right? Yeah. So
long ago,
right? But even in the last couple of weeks, he said that what people are telling him, what he's seeing as an appraiser is that you still have really strong bids, but instead of like 15, maybe you have 10. Right. But listen, I mean, that's still incredibly strong.
10 is 10, 5 is 5, 2 is better than none, right? 2 is better than 1.
We're gonna have a lot of good things to talk about the Gathering of Eagles this year.
I can't wait.
Yeah,
I can't wait.
We're heading out to Colorado Springs to the Broadmoor. We're inviting Mr. Tom Ferry to stage. So Tom's going to be joining us with this group of real estate brokerage CEOs, and you've used Teamerage a few times. Maybe we need more Teamerage leaders to join us at the gathering.
I would argue, especially for all my team leaders, Teamerage is just broker team versus traditional broker, and then all the teams that are out there. If you're watching this, you should absolutely join us. I will be there. This is one of those conferences that I share with people that, and I'm a main stage speaker, so I say this like with the most respect, even for myself. It's not about who's on stage. It is about who's in that room.
Yeah.
Right. It's the industry movers and shakers on the mortgage side, on the real estate side. Like I kind of plan my experience at Gathering of Deals. Like, who do I need a meeting with? Who do I want to sit down with? And who have I just not seen in forever? That I just want to say, hey, we've known each other for 25 years. And for the last 2 years, we haven't seen each other anywhere except maybe a Zoom meeting. So I'm excited. Is there room if somebody wants to sign up and go to this?
Yeah, there is. So you can visit Real Trends and check out the events tab. Steve Murray started this event a couple decades ago. Been bringing in the movers and shakers of the real estate industry for a lot longer than I've been part of it. But we're thrilled to carry forward the gathering torch and bring together people at the Broadmoor.
People love this gathering. They love it. They're super loyal to it. And we have time in the afternoon for them to do the kind of networking you're talking about.
Deals happen. M&A has happened.
Deals happen. People figure out new tech stacks.
Mortgage JVs have happened.
That's right.
Those core services deals are popping.
So fun fact for the person that's listening, I was looking at some 2018 data, right? So in 2018, $87 billion in top line revenue into the real estate brokerage industry called gross commission income, right? Core services, $1.87 trillion. Let me say that to you again, $1.87 trillion into mortgage, title, escrow, close, like all the different other services. So it is interesting to watch the teams and the teamerages and the indie brokers finally realize that over the last decade and race into these deals. So I know a lot of that stuff's happening there too, and that's just a fun fact for everybody to pay attention to.
Absolutely. I mean, we just wrote a story last week or the week before about a brokerage that their whole model is they don't make money on the real estate side. They make money on the title side.
Yeah,
so,
it was one of Tracy's stories, right? And it was
no, it was Samson Properties. I think Matt wrote it up. But they worked on it together.
But definitely like hit on the theme of like 100% commission model, but the brokerage is
I'm biting my tongue right now, but yes, there's a model for everybody. I know, but
not advocating it, profiling it. So check it out on Real Trends. You got to get a feel for what someone trying to mix it up is doing.
You could even argue like Southern California, because the commissions are so high. Like if someone's like, hey, I'm starting a real estate brokerage in Southern California, I'm like, do you own an escrow company? Do you have part of a title company? Because if you don't, you're already dead, right? So I think that's interesting. What is the agent site you guys have? What's more sort of agent centric in terms of content?
So like
Open House?
So Open House is our newsletter focused on agents. So
so
if you're on Real Trends, you can subscribe to 2 newsletters. One's Broker Source that's more focused on like the broker, the teamerage leader, the team leader, and Open House, which is kind of like agent focused and like broader housing market information. I think Open House is a lot of those like tidbits that you can repurpose into content to educate the consumer.
I agree.
So
we went from war and uncertainty and bad sentiment amongst builders into open house and come to a conference. Okay. So this has been super fun, guys. We covered a lot of ground. What I find with my listeners is they have a tendency to listen longer, right? Whether it's on YouTube or podcast, whatever it is. They take a lot of notes. They're probably going to have questions. Is there a way to ever get access to the two of you? Putting you publicly on the record here on the show.
Sarah at hwmedia.com. Send me a line. I answer lots of things.
Cool.
We're also very, on social, you can find us.
Yep.
Through editorial at HousingWire.com.
Sarah with an H, SARAH.
At hwmedia.com.
So that was the show. What are your thoughts?
Just a lot of information. And I think the bottom line was the millennials are 32, they're turning 32. And for the next 4 years, it's going to be more turn 32 than ever before. So there's no stop to the drive in the market. There's just no stop.
And that means prices are going to continue to go up.
Yep. I don't see any other alternative. I don't care if interest rates go up to 7.
Well, I heard Kudlow today. Kudlow is an economic expert on one of the news stations. And what he said was, right now, because of inflation, even though salaries and wages are up, which they related to, the consumer's losing 3% of their salary if you do all the numbers, in this current market that we have with this inflation. But he said, the inflation is not a depression because of lack of productivity. Our country is economically sound. It's just that we got too many people spending money in the wrong places and not putting money in the right places. And if that shifts, interest rates could come back down a little bit and stabilize maybe at between 4 and 5%. That was his prediction. If people in the government quit spending money, which artificially inflates us, obviously. So, I mean, yes, right now it's not good, but that doesn't mean it's going to stay not good because we have all these other factors maybe there's not 1,000 people looking to buy 51 homes. There's 500 people looking to buy 51 homes. Like they said, it's 2 is better than none. You still have people out there that are going to want to buy homes that can afford to buy homes. That this is not going to knock everybody out of the market because there's such a demand.
Well, I don't think government spending is going to go down. I just don't think it's going to go down. And as long as government spending is where it is, we're going to have inflation. And as long as we have inflation, people are going to put money in real estate. Investors, buyers, the sellers, the real estate market is going to stay very, very brisk. And that means price appreciation.
It does. And I know we loved saying when it was in the 2% handle area, live in the payment, not the price, right?
Mm-hmm.
But now I think the conversation has to shift is, okay, yes, you're going to pay 5 or 6%, so you're going to get a bigger tax break because you're paying more interest That's one way to look at it, right? And the other thing is, and you're going to continue to get appreciation. And if you wait, it's going to cost more.
That's
You
right.
got to
can't
figure
wait.
out
I
what
mean,
your
Sarah-
story is.
Sarah said she's telling her kids, don't wait, just buy a house. If you can get into a house, regardless of what the interest rates are, regardless of the price is, it's going to be the smartest move you've ever made, because we've gone up 30%. What'd you say in the last 12 months or in 4 or 5 months?
Yes.
30%?
Yes.
$150,000. I mean, how can you ignore that? You can't.
You can't ignore it. And as long as there's demand, there's going to be appreciation. And I am so convinced after listening to this, the demand. I mean, what did 5 million buyers out there? Is that what Tom Ferry said? I'm going to read.
We sold over 5 million houses last year.
Oh,
The thing to me is that the builders are, when they see this and they start slow down the building because they're worried about being stuck with houses, and that's scary.
yes, and I heard that, and I think it depends where you are. I think it's all local. Real estate is local, and I think that with our stats that Applied Analysis does and how people are moving here, and because we are a place where people move to, not away from, net. So I believe that the builders, if I was a builder, I would be offering some interest rate incentives, like, helping them buy down the interest rate somehow. So I think that they're going to get, Vegas is very creative, and I think that they'll figure that out.
Yeah, good strategy. Never thought of that.
So anyway, Jimmy, your birthday's Monday. You have a very, very wonderful weekend.
Thank you, my dear. Okay.
And I hope you have something fun planned.
I do. I'm going to. Yeah, I do. I'll see you when I see you. Have a great weekend.
Okay, everybody. Love you. Thank you. I'll put the PDF in the group, in the file section, and I'll also put it on in the post, in the feed. So everybody
I have a question for you when you log off. I have a question for you.